With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show. With me today is my guest that the last time was on, was warning us to avoid housing and equities like the plague. Please welcome back to the show, Harry Dent of the HS Dent Forecast and harrydent.com. Harry, always good to be with you. I missed your energy. I needed a dose of it today.
Yeah, good energy, tough forecast. But, you know, I was the guy that was most bullish in the 80s when everybody thought this boom would never last and said it was going to be the greatest boom in history. I got criticized for being too bullish. Now I'm getting criticized for being too bearish. So what can I say?
What could we say? Okay, I want to talk about all your forecasts. Let's start with housing. The last time you were on was in August. You warned us to be out of housing at least by 2024. I want to know if that's still the case, and want to bring up that Goldman Sachs now putting out a report. They expect home values to worsen through this year and continue amidst continuing skyrocketing interest rates and declining housing prices. And they predict that 4 U.S. cities will suffer the most catastrophic dips: San Jose, San Diego, Austin, and Phoenix. Will likely see noticeable increases before dramatic decreases of more than 25%. Thoughts on this, Harry?
Yeah, well, I mean, this is interesting because usually I'm the only guy. Nobody touches housing, like housing sacrosanct, you know. And last time I was almost alone predicting the bubble would burst. And now there are substantial other people. And this same group was saying the overall market could be down 20%. I see more than that, okay? The last crash was 34%. That's the biggest crash we've had in history, modern history, in housing in the U.S. This one should take us back just to those 2012 lows. That's all we're doing with the second bubble, just back to those previous lows. But that would be 50% for the average house. And of course, so less in like the Midwest and places like that and parts of the Southeast, but more in places like the ones they're mentioning. Of course, California, Arizona, Austin, those are the biggest bubbles, the West Coast and Austin and places like that. And Phoenix, that's where baby boomers are moving, you know, Sun Belt and everybody. And so, yes, but don't expect this. Everybody's now admitting we're going to have a housing correction, but they're saying it will be mild. When people, they don't say it's going to happen, then they finally admit, well, yes, but it'll be mild. Don't listen to these people because all they do is follow the trend. When it's up, they say it'll hold up. When it's down, well, it'll be down a little. This is going to be the biggest crash in housing of our lifetime, and then we'll probably never see one again for decades. Housing does not crash as often as stocks, but these were two housing bubbles, rare in history, and the last one burst, and this one will burst the same.
So, Harry, for the people at home who are maybe thinking of buying their first home, you'd say no way right now, regardless of where you're at?
Yeah. They're already be saying, okay, now is the time to buy. No, when we get back to where housing prices were in 2012 or so that's a good way. Housing prices have been very different, unlike stocks. They're different in different areas. So it's best to target the lows. So whatever the house or market you're looking at, what would that house been in mid 2012 around the last bottom? That's the best time to buy. When you see housing prices get there, and I don't expect that until at least 2024 sometime.
The last time you were on, you said we'll have the biggest recession or a depression of our lives next year. You're speaking 2023, and the economy isn't going to get strong again until 2024. So about the recession, but I believe your thesis is that the recession already started way back.
Well, yeah. I mean, this recession naturally would have been from 2020 into 22 by the demographics that I track. But the government since 2009 has just been stimulating. Things slow down, they stimulate more. So they've basically taken over the economy, and they created this second bubble. This second bubble would not have happened if they had not gone to long-term zero interest rates and made housing just a slam dunk to buy and make it irresistible. So they created the bubble, and now they're going to fight it. But I'm saying yes, that it did finally break, and once you break a certain amount, especially I'm looking at stock, and I tell people looking at housing, use the stock market as your leading indicator. Okay, stocks cracked first. They've tried to stop that bubble from bursting. Well, once stocks cracked over 30% in 2022, which they did, 34% on the Nasdaq. Now more recently down 38. And about as soon as we go to new lows, it's going to crash again. The more stocks crash, the more housing is going to follow. I say the stocks are getting ready to crash for a second time. You want to sell your house before that happens, because that's going to be alert for everybody. So really housing, you shouldn't wait at this point, because housing takes longer to crack, but it also takes longer to sell and freezes up very quickly.
Let's dig a little deeper on the equities, because I want to say that's probably your most controversial of the calls, because you know what the folks at home are going to say. Oh no, here comes Harry Dent warning us again about the greatest stock market crash. And there's different definitions or interpretations of what you want to call a crash, but we didn't see a crash of the S&P in 2022 per se. What do you say to them, and what's your take on stocks and crash?
Wait a minute. No, we did. The S&P went down over 20, I think 5%. The Nasdaq went down 38% at worst. So we did see a crash. Now you have to understand, and people in my newsletter know this. I've spelled this thing out in detail, and I'm just going on past crashes like 2000, 2002, 29 to 32. It takes 3 waves down to complete a major bull market or a major bear market. All we've seen is that first crash. And my indicators show us we've already begun the second wave down since mid-August, but it has to make new lows to accelerate and go a good bit lower. If that happens, that's only the second wave, and then further down, say in the next year or so, into 2024, we'll get a final wave down. So you can't feel like this thing's over normally until you see 3 healthy waves down, and we've only seen the first. So this is not a buying opportunity in stocks, and if it's not a buying opportunity in stocks, it definitely is not in housing. And you'll have plenty of time for buy opportunity in the house. Housing took years to turn around. Stocks bottomed last time, in early 2009. Housing didn't bottom until mid 2012, 3 years later. So housing, you'll have plenty of time, but stocks, you're going to want to get back in. Probably, again, if I had to tell people, if I had to say, I have to tell you today when to buy stocks and I know nothing else, I would say around summer, July 2024. That's when I would expect a bottom. So still a ways away, obviously.
Another one of your forecasts was regarding crypto, right? And you said it would drop even more than stocks. Now, we spoke before, obviously,
and it already has.
The FTX drama and the whole crypto carnage. So your take, can anything in the crypto realm be resuscitated? I mean, Bitcoin aside. Well, let's get your thoughts on Bitcoin. I mean, it's getting some breathing room and renewed interest here as we start the year.
Yeah, again, same thing. Bitcoin is ahead of stocks and will probably bottom before stocks, maybe late in 2023, where stocks might be mid 2024, because it's kind of the leading sector. It goes up more, it goes down more. It's already been down 70% when stocks were down 34 to 38 on the NASDAQ and 25 to 27 on the S&P. I am predicting that, and I'm just following the same bubbles in Amazon and .coms. I'm telling you the same exact proportions, the bubble and the burst in the .coms is now 22 years later, that crypto will bottom around its late 2018, early 2019 lows around 3,250 to 4,000. So it's still, even at 16,000, down 70%, it will be down 95% if we do the same thing we did with the .coms. So it's not time to buy crypto later, but I also advise crypto is the next big thing. The .coms were the next big thing emerging in the late 90s in that bubble. They were small. That's a shakeout, which is necessary, Dan. This is a good thing. You have tons of new entrants, and then you shake them out to the ones that are really strong and have their stuff together. That's what the shakeout's for. That's what happened, back in 2000, 2002. And then you see the real boom, okay? So the best companies will survive. We have 40,000 coins by some count. This is ridiculous. All they are is cheap IPOs. Coins are cheap IPOs. The blockchain technology is real and will emerge after we wipe out all these ridiculous coin companies.
Are there any
so Bitcoin will survive. Ethereum will survive. Most of these companies will not survive.
So if you were to, place a bet on some of these, what would you be looking to buy?
I would be looking to buy the leaders, Bitcoin, Ethereum, companies like that at the bottom. And I'm not looking for a bottom until we retest those lows in late 2019. That's also an Elliott wave count. That was simply a huge bubble. It was simply the fourth wave correction before the fifth wave final bubble. All we're doing, and this happens in bubbles. I've now studied since these bubbles came, all bubbles in history. Bubbles basically go back to where they started. They bubble up way beyond the fundamentals, crazy, and then they go back to where they started. That is 3,250 to 4,300 on Bitcoin. That's where it should go. Then you buy, because it could go, literally, the projections also tracking the .com bubble before the real boom. Bitcoin could go to 500,000 to 1 million. My actual target right now today is the next boom will take it to a peak of 780,000.
You're talking bubbles, and anytime someone mentions bubbles, I just keep going back to that quote of when Jim Rogers was on, and he told me there's two kinds of people who get burned in bubbles, skeptics and believers. And the other day, I was reflecting on that, and I was like, well, who are you better off being if you had to choose? Would you be better off being the believer because at least you took the risk and could make a lot of money? Could you make that argument?
You are better being the believer at first because bubbles have a lot of momentum. You just have to be smart enough to take your profits before it's too late, because bubbles grow more rapidly than bull markets, literally 2 to 3 times the rate, but they crash twice as fast as they grow. So when the bubbles burst, it happens very fast. So it is good to go with a bubble. And this is the second bubble, and it's actually the thing I'm telling people, it's actually tracing at a higher level the first bubble, and basically it peaked right in line with where the first bubble peaked after going up for about 5 years. So that was a good time to get out. Okay, so that would have been the best thing. You might have gotten out at 50 before, or 69 at the top, or you might have gotten out at 45 afterward. But anywhere there is going to look good when it ends up back where it started at 32.50 or so.
Going back to your laundry list of things going to zero, you're very bearish gold. As I'm sure you're aware, many are now bullish gold. People who were bearish turning bullish, looking at the technicals of gold.
Yeah.
Many feeling this is the year of gold. Have you had any change? Have you had a change? I guess you haven't had a change of heart when it comes to gold price.
Okay. What's the best analogy for this? 2008 was the first bubble and the first burst, and it did not go through like 29 to 32. It didn't erase the full bubble. Government stepped in and stimulated extremely hard and did it for 13 years until recently, okay? So they stopped the bubble from bursting, okay? So we have to go back and wipe out this bubble. Bubbles are not bad. They basically help launch a new sector and raise a lot of money for a lot of new companies. The point is, though, all those new companies can't make it. You have to shake them out. So this shakeout stage, which we're in and we'll be in for a few years, is important also. So you have to buy the winners at the bottom. And I'm going to tell you, Bitcoin's going to survive this. Ethereum, many companies, there might be 10 or 12 really solid companies that are going to survive this thing and have an incredible boom for the next 15 years. And that's what the dot-coms did. But most of those dot-coms, remember how many dot-coms there were? There was a dot-com for every name in retail possible, dog.com, cat.com, whatever. And they all went under except the best ones. And the best ones then changed the economy. We're all online now. It's a giant industry now. So This is the way the economy works. There's nothing wrong with it. When people say this can't happen or not, they haven't studied history. I'm just looking at exactly what happened in the last bubble. And this has now clearly been a bubble of similar magnitude. Why would you expect anything else other than a 95% crash? Because that's what happened last time, including the leaders like Amazon.
And to that point, let's go there. We're seeing the layoffs across the tech sector here. Would you, as an investor, say if you're looking to buy some of these tech stocks at depressed levels, how can you figure out which ones have a long-term plan and this is just a momentary downturn?
Well, this is not momentary. Everything's going down. Some companies just go down more than others. So the first sign, when we're getting towards a bottom here, let's say in mid-2024, and the NASDAQ is down enough to say we're near a bottom, like down 80 to 90% instead of 40 to 50 to 60, then you start like, okay, whichever company's held up the most. If a company, like say, is only down 80%, well, it did a lot better than the companies down 90. But you also always look for the companies with the strongest market share and dominant. Nobody is taking out Amazon, okay? Amazon is the biggest, most diversified retailer in all of history. It would have been the Sears of the 50s and 60s boom, okay? And so Amazon is going to survive. For me, it's very simple. I'm not going to analyze 40,000 companies and down to the 1,000 that might survive this or a couple hundred and then pick the best one. That's too much work. I'm just going to buy the leaders and then look at how the stocks have performed on the way down to maybe refine that. But it can be that simple. But if somebody said, what do I do? Okay, I'm going to buy Ethereum and Bitcoin in early to mid 2024, maybe late 2023, because I think if somebody said today you have to do it and can't change your mind, that would be what I'd say today. So just look at it and refine that in the future. But you don't have to be complicated about this. You can pick the best stocks. That's a lot of work. I'm looking at the whole world and all major sectors and countries. I don't have time to decide if Krypton is going to beat Bombaton, okay? I don't have time for that.
So Harry, give us an inside look at, your portfolio, things you're doing and not doing. So if I hear you correctly, you're avoiding equities like the plague, or would you be buyer of Amazon here?
Okay. No, yeah. I would buy particular stocks at the bottom, but right now in the downturn, since everything goes down so much, I'm just playing this by being short SQQQ. That's 3 times the NASDAQ. Now, the reason I'm doing that, it's 3 times so I can keep capital on the side. So I've covered being 100% short 3 times. Then I have 60, 70% capital on the side to take advantage of opportunities that pop up. When there's a downturn, there might be a distressed house down the street from me that I can buy for 20 cents on the dollar and then fix it up and turn around and sell it in a year. Okay, well, I would have capital to do that sort of thing. So that's the way I'm playing it. I don't recommend in an already volatile downturn that people be triple short. That's for traders. But that's my strategy. I do the triple short with a small part and then leave the rest to adapt. The other thing we have to realize here, although everything's following like past booms and bubbles and stuff, this is unique because never before have governments created and then also fought the bubble burst. The Roaring '20s bubble was a natural bubble. Even the '90s bubble, tech bubble, the first tech bubble was largely a natural bubble. You get storing, tech's doing really good, ripping off on its 45-year cycle, new technologies moving mainstream at the speed of light, and investors just overvalue it. They always will. This time, it's all been government stimulus, pouring money into financial assets. That's what they buy when they inject money. They buy financial assets, inject more money into the whole pool, and all financial assets go up. So now we have an everything bubble. So everything falls, and then things will more selectively emerge in the next boom once we've shaken out this bubble. So right now, the best thing I can do, I don't want to short everything. I'll just be short the NASDAQ stocks, which is the lead stocks to me in the stock area. So that's the way I'm playing. Somebody more sophisticated can pick more stocks or different sectors. I'm just being short the NASDAQ.
And what I'm hearing is you want to be liquid.
Well, yes, that's right. I could do that one time short with all my money, or I can do it with a third and leave the other 2/3 to look for opportunities if they come. That money's going to be there regardless to buy at the bottom. But again, all types of things could pop up in between, and I've got money to jump on something more short term if necessary.
Harry, I need and want to get your thoughts on the debt ceiling. I want to know if you think there's more to it or just noise. And just want to share this quote from Janet Yellen, who urged Congress to raise the debt ceiling. She says, "I respectfully urge Congress to act promptly to protect the full faith and credit of the United States." We've gone through so many of these. Is this one different?
You know, it's the fact that we've had to go through so many makes it different. At some point, there's going to be some people in Congress just to say, look, we keep saying, oh, we have to, but at some point you got to make a stand. They might make a stronger stand here, but in the end, yes, you have to do this. You can't afford to show that the U.S. government even temporarily will default on what are considered the safest, highest quality long-term bonds in the world. I think you can't afford to break that. So I think in the end, they're not going to default. They're just going to fight about it, and then they'll cave at the last minute. But I wouldn't be totally surprised if this fight didn't go a little more down to the wire on this one, because the Republican side just thinks, well, we just limit debt. Well, you have to limit spending, you idiots. We're going to have to cut spending if we limit debt. And this to me is what's going to go down in history as the greatest crime. You should be running surpluses or at least balanced budgets in booms and then run the deficits to stimulate in downturns. We've been running the greatest deficits in history in the greatest boom in history. And then, of course, we'll have to stimulate way more when things fall apart. This is going to look like extremely bad policy in history, and it's going to look at extreme bad policy to create a second artificial bubble that then burst even worse than the first bubble. And that's what's going to be the story here, I think, in the end. So it's going to look bad, and I want it to look bad. I don't want governments to ever do this again. After the '20s bubble burst, we didn't see bubbles anywhere for several decades until the '90s, okay? Why? People remembered that crash. That crash, 25% unemployment, 89% stock crash. We get 50% stock crashes, 60% once a generation, but 89% for people retiring? Oh my God.
Where does the US dollar go from here?
Okay, in general, and I used 2008 for the proxy there, gold went up in the early stages like it's doing now, but when things got difficult and we got a deep recession, it went down 40 to 45%, just like everything else. Just didn't go down as much as other commodities or as much as stocks, but gold went down 45%, okay, in the end. So it wasn't the safe haven, but it wasn't the worst place to be, okay? So this time, you know, we have gold hanging in here, and I think it will go down. And my target is not the worst. It's 900 to 1,000 range. Okay, it's just back to the last low. So that's not going to be the worst place to be again. But I don't want to be anywhere that is going to do poorly. There's nothing. Cash is the safest. No matter what happens, your cash stays the same. But history shows in the early 30s and in deflationary downturns like 2008. that the treasury bonds are what do the best because the money has to run somewhere, and the U.S. treasury bonds were the best safe haven, and the 30 years better than the 10, okay? And ZEROS, which is an ETF that has 25-year average treasury bonds, will do about 50-60% better than TLT, but TLT is more liquid and easier to buy and sell. So that's where you put your money, either in cash, just to say, I don't know what the hell's going to happen, and bury it in your backyard, or you buy TLT, ZEROS, or 30-year and 10-year treasury bonds. You can buy AAA corporates, and they'll hold up well, but nothing will hold up better than the safest bonds. So why would you be anywhere else? So I'm not diversified in the downturn. I'm either short stocks like PSQ or SQQQ, or I'm in more, and for most people, they should just sit in the treasury bonds, and the treasury bonds will go up less fast than stocks go down at first, but at the crisis, like in mid-2008 to late 2008, the treasury bonds will go up the fastest, go be better than anything. So you have to be more patient on them, and when you see them bubble up, then you get out of them.
I'll take on the Fed, your read on the Fed. How much longer do we see rate hikes?
It looks like to me they're going to start slowing down because it's appearing they kind of overreacted here. My point of view has been, look, this entire stock market bubble, this second one, has not been due to the economy. The economy holding up and the stock market going to new heights by far has all been because of stimulus. Just to pause would cause this bubble to burst. And now they're just going to tighten less. So I think we still continue to crash here. But what I am looking for, the sign to me that we're going into the next phase, which could happen anytime, we break that last low on the NASDAQ. I think it's 1,089 on the NASDAQ. We break that low, then the next wave, which has already started, accelerates, and then we know we're in a deeper crash. And there's a point where consumers change, investors and businesses change their point of view, no longer think the Fed's in control, no longer think this is just a little minor recession or a minor crash, and everybody pulls back and you can't stop them. And then we end up going down for a good while.
Good thoughts from you, Harry. I know we threw a lot of things at people, and I think a lot of folks are feeling overwhelmed by what's going on. So I guess just, final takeaways, if you could tell the folks at home, one thing. You've painted a very dire picture of 2023. What should we be doing, and how should we be coping, or how could we get defensive, aggressive?
Okay, yeah. Here's the best way to view it. Instead of the crash of our lifetime, look at it as the buying opportunity of your lifetime. Everything, now this is rare. Even in the Great Depression, the 29 to 32 crash, this didn't happen. Real estate reacted differently than stocks, and commodities crashed way before. Everything's going to go on sale. Commodities, gold, real estate, and all sectors, high and low, luxury, not, stocks, things that bubble. The greater the bubble, the greater the burst. So you can use that as a simple guide. All you do is get out of the way. Be safe. If you protect your money, okay, you're missing, well, maybe the markets claw back some, and maybe this thing doesn't go as low as I think, but you're not going to miss a lot. If it keeps going down, everything's going to be on sale, and the only way to take advantage of that sale is to be liquid, to be in cash or high quality bonds that preserve your value or grow. And then you turn around. That's why I said, if these bonds do bubble, this will be the last bubble from my point of view. The final bubble in all these bubbles will be the treasury bonds, the safe haven that go when the bubble crashes. If those bubble, then you sell those and you convert those back into long-term growth assets like real estate and stocks, all the things we like to own long-term. So you just have to say, look, things bubbled up. It wasn't anybody's fault except for governments for overstimulating, but it wasn't any of our faults. Just note that when bubbles, look at bubbles. That's what I've done. I've done the research for you. This looks exactly like a bubble, quacks like a bubble, burst, bubbled up just like the last one from 95 to 2000, bursting just like the last one. And if it does, it's got a lot farther to go. Be safe, be liquid, and the world's your oyster just a year and a half from now, probably. A year and a half, if you just wait, everything's going to be on sale. And you know what? At that point, people will be too scared to buy. They're going to say, well, everything's going to hell. Oh, da, 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 da. No, that's when the smart money buys. If you know it in advance, you can be the smart money. If you're reacting on the way down and then you finally panic and sell half the way down and then it crashes, you're all, shell shocked. You're not going to even have the intelligence to buy when you have the sale of a lifetime in front of you. You'll never see stocks or real estate or anything you're in at these prices again, just like nobody saw them after 1932 to 33, ever again.
Harry Dent, on that note, it's always great catching up with you. Thank you.
Real quick, harrydent.com. I got a free weekly newsletter. You want to hear more and keep up, and this is the time to at least listen to somebody like me and have some ammunition to fight your stockbroker who's going to tell you otherwise. harrydent.com, free newsletter.
Oh, all right. Thank you, Harry Dent of harrydent.com. And thank you all for watching. We'll have more great coverage and content coming your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com. So many .com, so many websites. danielacambone.com, so you can stay on top of all these great interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.